You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from a little thing we like to call around these parts, the Options Insider Radio Network. 14 programs now on the old network for you guys to choose from and enjoy. The 14th just coming online in the last couple of weeks. That is, of course, our This Week in Futures Options program, the program where we break down all of the amazing and fun and interesting developments in the world of futures options. So you're talking crude oil, gold, ags, pretty much everything else in between. Whatever's lighting it up that week in futures options, we're probably going to talk about it on that show. So if you want to stream it live, you can join us 3 p.m. Central, 4 p.m. Eastern. We stream it right here, same room we do this one, or of course you can find it on demand pretty much wherever you find your favorite Options Insider programs, including, of course, the mothership, the flagship, theoptionsinsider.com. TWIFO has just been added to the overlay up there, so you can find it up there along with all the other programs over there. Of course, and all of your favorite outlets as well, iTunes, TuneIn, Stitcher, the ever-expanding Google podcast empire. Whenever they get all that fixed and up and running, you guys can check it out there as well. Or, of course, if you don't want to wait for that, you just want to grab it on your device of choice, and just grab our mobile app. All of our shows, everything else is available there. You can build your own playlist, download, stream. Pretty cool if you want to go on a plane, you want to download a few shows ahead of time and save them in the app, you can do that, which is a pretty fun thing. And of course, no matter how you listen, we love to hear from you guys. Send us your questions, your comments, your feedback, your insight, your pearls of wisdom, not just for us, but for your fellow Options Insider and Volatility Views listeners. And joining me on the program today, beaming in from his own current corner office. He's like a hermit crab. He pops up in different people's corner offices every week. This week he's over there in the Global Option Pit HQ by way of Typhon, Mr. Mark Sebastian from Carmen Line, as well as, I should say, the Option Pit. Mr. Greasy Meatball, welcome back to the program, sir.
Good to see you. When am I going to get my Where's the Meatball music? I'm we'll
have to work on
really
that.
Annoyed that Russell has his weekly rundown music and I don't have my Where's the Meatball music.
Well, he has a segment, though. He has a thing he talks about.
Oh, well, we should make it a segment. Where is the meatball?
We'll play Guess the Meatball at the top of the show.
Yeah,
that could be
guess where I am.
That could be misconstrued in so many different ways and bring us maybe some interesting new audiences to the program that we haven't reached before. So maybe that's something.
Yeah, we'll have a lot of people Googling Where's the Meatball.
Before we get too far down that rabbit hole, let's also welcome on he of corner office fame / infamy. Someday in the far distant future, perhaps will also be known as Dr. VIX once he gets that nice piece of paper with his name on it. In the meantime, we just call him Russell Rhodes, the senior instructor over there at the Options Institute. Once again, joining us by this magic cutting-edge technology known as the telephone. Mr. Rhodes, welcome to the program. Hopefully we'll get your Skype. I guess they haven't paid the Skype bill over there at the Options Institute / SIBO, huh?
No, we have not. That's exactly what it is. We haven't paid the Skype bill. I like that. Actually, I think I got a solution for us, and we're going to be okay this time next week, I promise.
Oh, I like that. Good.
Yeah. As long as I remember to implement the solution.
All right. Well, in the meantime, we're going to keep rolling with the program. Maybe we'll see if we can brainstorm some ideas in the interim here, but we're going to keep on rolling right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is, of course, the portion of the show where we break down what was going on from the week that was and indeed still is from volatility trading and analysis and activity perspective. And, of course, we are recording this and indeed streaming it live noon Central, 1 p.m. Eastern here, so right in the middle of the session. It's been an interesting day. We, of course, had non-farms this morning, so that was always an interesting factor, always an interesting way to kick off a Volatility Views program because it adds that nice little wrinkle to the end of the week. Otherwise, if you're going into the end of the week, things might be quiet going into a weekend. Going to start taking some of that vol out and everything else. But on non-farms, you don't do that. You don't see that as much because, of course, something might actually happen that morning. So everyone kind of waits with bated breath for that number to come out. If you weren't paying attention this morning, it was not as good as perhaps expected. 160,000 jobs added. They were expecting a little over 200,000. Of course, how you parse that is why economics is called the dismal science. A lot of different ways to parse a number like that and its impact on the overall market. As we are recording this, like I said, middle of the day here on Friday, the 6th of May. Most of the major indices off slightly on the day. S&P off about 0.3 of a percentage point or so. NASDAQ leading the charge a little bit down, slightly more, and the Dow pretty much unched on the day, slightly down as well. And of course, all of the whatever non-farm premium there was in the marketplace being relaxed a little bit. VIX cash also exhaling a little bit right around the 15.86 level or so right now. So a lot of interesting things to discuss, but I think we'll start in the realm of non-farms because it's always such a question mark, or Russell and Mark, no pun intended. For a long time there, it was this great moment of anticipation. You'd see everyone really dialing into it. Non-farms imminent. It was kind of a big deal. And then for the better part of the last few years, non-farms has kind of become a bit of a meh, as I like to say. We've seen a couple kind of break that mold lately where they've actually had a little bit of impact, but overall, the big market-moving non-farm events in the last couple of years, and you can really count them on one hand, if not a couple of fingers. So it hasn't really been the big move. Any surprises, any interesting developments that caught your eye from a non-farms perspective? Maybe, Russell, we'll start with you before your phone bill goes out as well, sir.
It's difficult to say something when nothing happened. What was surprising to me with respect to the non-farm payroll numbers, we were taking a look at, and it's from yesterday, not today. I was actually kind of surprised that we had less than a point premium between VIX cash and the May future going into the non-farm payroll number. It's kind of, usually we see a little bit of a narrowing of that spread, but it was already pretty narrow, so it's kind of, it hasn't changed much at all today. So just, we were kicking that one around yesterday before the number, and it's kind of like you said, it's become kind of a meh number, and that's kind of how the futures versus the index was looking at it as well.
Yeah, it's been a little while since we saw non-farms that really kind of rocked the market. Again, those were used to be kind of par for the course every non-farm has had the potential to kind of be this earth-shaking event. And then recent history, perhaps not so much. Mark, anything catching your eye in today's non-farms, and as well as kind of the week that was from a volatility and VIX perspective?
Yeah, we had a nice little batch of volatility this week. The VIX has managed to stay above 15 the entire week, other than Monday. So a little bit of a shocker. I'm a little surprised at the way things are, but I feel like vol is kind of starting to peter out, and I think we'll see a 14 next week. Before not making my crystal ball yet, but just saying things look like they're petering out a little bit. The other thing that I'm really paying attention to is how flat the back end of the VIX curve is. Most notably, July and August. I mean, it's moved a little bit, but this morning at one time, August was only trading at about a 20-cent premium to July, and as I'm looking now, it's still only, 1980 versus 2015, 35 cents. That's, to me, seems far too tight, and the only reason I can think that would exist is that July has some of that Brexit vote, which is in there, but that is one piece that I am paying attention to, where July looks, I think, overpriced relative to August and September.
Mr. Russell, I know that kind of perks your ears up as well. What are your thoughts there?
Well, and we're just jumping ahead today, and next week I'm going to be at the financial advisor part of the OIC conference, and I'm doing a panel on the elections and market volatility. And what Mark might be picking up on is that the two conventions are done by the end of July, and you got to figure if they can, the Fed will try not to do anything between the conventions, and barring a have to do something, but they're probably not going to do anything between the conventions and the final election in early November. So I wonder if that has something to do with the flattening on the curve that Mark just talked about as well.
Yeah, Russell, I was looking at this July August spread, and it really makes me want to do some sort of like short 5, long 6, short 9, long 10, July, August kind of calendar-y type of spread.
So would you call that the Trump inaugural premium or spread or something along those lines?
Yeah, Janet Yellen's going to be fighting for her job, I guess.
I saw that comment. I have to say that I'm not a Trump fan, but that comment made me think, maybe a vote or two in his way, in his direction.
What do you mean you're not a Trump fan? I was at your house, and
you saw my life-size effigy?
The amount of "Make America Great" plastered all over your office over there is pretty astounding, Mark.
Yes, my life-size effigy is smiling at me right now from across the room, fake here and all. But you're right, he is the de facto nominee pretty much at this point, which is an interesting development, I think, to say the least, here in the U.S. So we won't go political, but I did notice he did throw out that little nugget about Janet Yellen that she wouldn't really survive long of a Trump administration. That kind of brought a smile to my face, I'm sure, to a lot of people as well. We've commented many times on this show that the way the Fed has just been injecting needless turmoil and agitation and froth and volatility in this marketplace for the better parts of the last 6 to 8 months, certainly since late Q3 of last year, is kind of really, for what little they've actually accomplished and achieved, is certainly, I think one could certainly raise an eyebrow at that. But moving away from any sort of political condemnations and discussions, let's move into interesting things that are developing in the world of all things volatility. And before we get into the activity that caught our eye this week from a VIX perspective, it seems like another day, another new VIX ETP or related kind of physical product out there. We talked a lot recently on the program about, of course, the not really late great, but it seems like it's approaching that status, the VIX up, VIX down, which attempted to replicate the actual tradable VIX cash, or try to deliver that in some way, shape, or form. We've talked many times about the many different things or obstacles they had to jump over just to try to deliver that, and really the efficacy or perhaps lack thereof of them being able to do that. Now there's a new competitor in that space, not attempting to do the exact same thing, but along a similar route. about. This one, instead of calling VIX up, VIX down is VMAX and VMIN. It is the iPath S&P 500 VIX short-term futures ETN. As the name implies, it's actually playing a little bit different part of the curve than most of the other products out there. You know, we always talk about things like VXX and others that are always so negatively impacted by the rebalancing of buying expensive long-term vol, selling cheap near-term vol. That roll risk, that roll yield just crushes them over time. This one attempting to play solely in the domain of that near-term portion of the curve, and that really became possible just a few months back with the addition of the VIX weekly futures. Now that you have those weekly futures contracts out there, you can start seeing more of these products, these weekly and short duration type things, because they actually have an underlying that they could play around with, rather than, you know, the weird machinations that that the VIX up, VIX down people had to go for. Again, this is not trying to replicate VIX cash, but it is trying to give you a little bit more exposure to that nearer term portion of the curve, which I think is interesting. To say the least. I know, Russell, you pay attention to all the new additions and permutations of the VIX ETP universe. What are your thoughts on this one and attempting to bring the VIX weekly futures out there to the masses in a more digestible form?
I think, you know, I think it was almost expected. In fact, when we announced the weekly futures, one of the first questions was, you know, how quickly before somebody puts an ETP together. And I think it was almost a race to see who could get out there, because there's such a demand for getting something that will as closely replicate VIX, as possible. One of the things I've been monitoring ever since we introduced the VIX weeklies is the short-term curve, and I throw it. I don't necessarily use it for my blog every weekend, but I actually keep up with it. And the near term of the curve is usually pretty darn flat. So I think we may not have the same type of contango issues that we've seen with VXX and the other guys. So this one might actually, if anything, on a pricing basis, be pretty interesting to keep an eye on.
Yeah, you know, it's kind of an interesting thing. You're right. It is a bit of a race at this point. It seems like that nothing in the volatility space is legit until they have the corresponding ETP to somehow legitimize it. And so now we have the first of, you're right, I'm sure many to come, near-term, short duration, call them what you will, volatility ETP products, all attempting to take what's going on over there in the near portion of the curve and the VIX weekly portion of the futures curve and try to deliver that in some sort of digestible way that is somehow, at least in the marketing materials, more palatable to the end user, who for whatever reason, a lot of retail still a little put off, intimidated, terrified by the concept of trading futures, or they don't have a futures eligible account. More brokers are making that process easier to add a futures account to your regular equity securities account, but still it is an extra hurdle to have to jump through. So a securities type product can alleviate some of that. Mark, I'm sure you've been paying attention to this one. What are your thoughts on this one? And it's not really the same camp as the VIX up, VIX down, but it's in a similar ballpark.
I mean, it seems a little more close to a VXX. It seems like a new take on what VXX is trying to accomplish, rather than trying to track the VIX cash itself, which I think was the folly of VIX up, VIX down. It looks like it's going to do a decent job. Russell, I mean, I'm still kind of, do you want to briefly walk people through the basic structure of these ETPs without giving them a commercial? Because it's a little hazy.
That's what I was actually just reading that when you said that to try to formulate something. You didn't give me enough time to get super smart on this.
Yeah.
But
so
go ahead.
No, go ahead.
No, I was actually, you know who's smarter than you and me put together?
Who?
Bill Luby.
Oh,
He
yeah.
did an excellent blog on this.
I did read part of it. It's
okay.
I'm gonna go there right now.
While everyone's scrambling to read, it is indeed a late breaking product. It just came out, I believe, Tuesday. over there for this new iPath short-term futures ETN. They're referring to this as the first regulated investment company fund to invest in VIX futures and to seek to track movements in the VIX index by maintaining a weighted average time to expiry of their investments in the VIX futures contracts of less than 30 days at all times. So there you go. Very, very clear and straightforward language on this one. They also term it as it seeks opportunities that arise should the VIX spike upward, while the inverse, of course, VMIN seeks to gain opportunities as the VIX falls. Pretty straightforward. It's going to be actively managed, and that's another interesting component to these. We don't always see that actively managed component becoming a more interesting aspect for a lot of ETFs and others out there trying to offer some sort of option risk management type functionality or volatility exposure. It tends to need a actively managed portion at that point. So interesting stuff. Again, they just listed on Tuesday, so the volume is still nominal, and there's nothing else to really read in terms of that. I just wanted to have it out there on the show here before. We'll have more time in future episodes to really break this down in last respect. While you guys are scrambling there, anything else you want to add here on VIX, VMAX and VMIN before we dive into Russell's weekly rundown?
I can't wait till they list options.
The only thing, I don't think they're iPath.
They're not. They're REX shares.
They're REX shares. So,
I'm sorry. I was reading. I was combining a couple of different things. That is of course VXX's iPath. This is REX shares. You're right.
Right. Just to give our buddy Rex a proper shout out
from the volatility mecca of Connecticut. REX shares based actually in Connecticut. So a few hedge funds over there. There's a little bit of volatility wherewithal in my old stomping grounds. But now time for us to keep on rolling. If you guys have thoughts on this, again, it's a pretty new product. But if you have thoughts, maybe some utility for it, good, bad, let us know. Meanwhile, we're going to keep on rolling. It's time for Russell to take the reins via the magic of the telephone. It's time for Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
Russell, I know it might be difficult for our listeners to make out all that you say through the magic of Alexander Graham Bell's technology. But that said, what caught your eye in this relatively light volume week from a VIX weekly options perspective?
Yeah, this is a tough one. But today, it looks like somebody's been coming in kind of in an interesting fashion and actually buying the 19 strike calls that expire next Wednesday. And keep in mind, this is after the employment number, and more have traded than the open interest, and they've been trading on the offer side. In fact, just over the last couple of hours, somebody's come in and bought almost 1,000 of the May 11th 19 calls. So if they hadn't done that, I'd really be stretching for something to talk about right now. But there's at least one person that seems to be opening up a new position, straight up position, not a spread or anything like that. And looking for maybe they know something maybe they've been talking to Putin and they think something's going to happen over the weekend.
That is a pretty near-term play, as we do see, of course, with all of our paper over there in the VIX weekly options, and they have been lighting it up this week. Not so much in terms of overall volume. You guys remember a few weeks back where we discussed, of course, the big 1x2 trade going up, and that usually jogs volume for the entire week. This week, we didn't really have that one big whale kind of lighting it up. As we're recording right now today, right around 12:30 Central Time, a little bit south of 300,000 contracts, so about half of a typical ADV. So it seems like we're on course for a pretty typical day out there today. The rest of the week, pretty light volume-wise, about 300,000 contracts yesterday, which is surprising going into a non-farms number. You think you might see a little bit more paper just coming on to put something on or to hedge or remove something against that. Didn't really see a lot of that. Wednesday through Monday, also pretty light, all pretty much under the ATVI this week. That said, there were a few size trades that caught our eye this week. Russell alluded to one of them out there in the weeklies. We also saw a little bit longer term upside call buyers coming in today, about 70,000 of the AUG 25s going up. Paper gobbling those up for about $2.05. Of course, like everything out there in VIX land, There is actually about 75,000, so it's about close. So he could indeed be perhaps buying something back out here, but there is enough open interest to cover him here. But still, like everything in VIX land, there always is probably another leg on to be cognizant of, and there's so much open interest on just about every strike that it's sometimes hard to see the forest for the trees. But we do like to point out a few interesting ones that caught our eye. Also, looks like an interesting bit of looks like a vertical spread versus maybe some downside puts going up today, about 15,000 times of the June 2025 vertical versus the 15 puts that going up, like I said, about 15,000 times out there. So it looks like they're selling the puts and buying the vertical, and then jumping back to Wednesday, some funky trades going up on Wednesday. It looks like what might have been, again, we have to dig in a little bit more to see exactly what went up here, but it looks like what might have been the AUG 21 straddle versus the 22 calls. They were gobbling up the calls, so it looks like they had at least a short vertical on there, and perhaps also selling the puts, or it could have been a combo as well. But a bit of a funky one. Usually, if you're going to short a straddle out in VIX land, if you're going to put on a corresponding hedge leg somewhere, you're going to put it up on the upside. So it makes sense they were perhaps blasting out that 21 straddle and AUG, and then putting out a pretty tight upside leg, doing it on a ratio too. That also could be another effective way of doing our little 1x2 dance, but doing it with a straddle instead of just the short vertical 1x2. So that's maybe an interesting way, interesting new wrinkle on that trade. I haven't really seen a lot of research on the short straddle as a way versus the too long, kind of a different way to kind of leg into a bit of a ratio spread there. But interesting, of course, nonetheless. Also saw, looks like a bit of a short stupid out there in July on Wednesday, about 7,500 of the 22-27 vertical stupid, call stupid out there in July. So we love our stupids here on the network. And then some other decent size trades caught our eye. Looks like a lot of put rolling, in particular the May-June 14.5 put spread going out 11,000 times earlier in the week, or 10,000 by 11,000, rolling from the May out to the June. And then it looks like another one of those funky, perhaps straddle versus or combo versus upside calls. Again, I have to read into the tea leaves a little bit more to see exactly what was going up on this trade. But this was on Tuesday, and this time it was the June 19, straddle / combo going up about 4,500 times versus, again, picking up on the upside. This time the June 24 is about 14,500 of those. So a bit of a funky ratio leg. I want to dig into both of those a little bit more because that is an interesting, perhaps new wrinkle on what we've traditionally talked about a lot here on the show and went up size a couple of weeks ago, which is just the traditional short ratio spread, sell 1 by 2. Selling 1, buying 2, and also having the put laying on it would make it interesting, I think, to say the least. Looking up overall what was hot from the week, and indeed what's the hot strikes right now out there in VIX land, hot being a relative term because there wasn't really a lot going on this week. The May 25 still leading the charge, number one with a bullet, almost 350,000 contracts open out there. Again, no puts to be found in our top 10 for this week. And number 2, the July 30 is about 260,000 open over there, followed by the ever optimistic May 30s, 245,000. Number 4, the May 20s. A little bit more relevance of a strike, 222,000 open there. 220 of the May 22. So May upside, pretty much, not surprisingly perhaps, leading the charge, taking up the top 5. Number 6, drop off a little bit to about 187,000 of the June 30s. Then number 7, the June 25s, 186,000 of those as well. May 23s and May 28s taking up number 8 and 9 with about 175,000 each. And then rounding out the top 10, 165,000 of the AUG 30 calls, the ever optimistic, ever exciting AUG 30 strike. About 7.63 million contracts open overall. Pretty hefty amount of open interest given the fact that we have had some light volume weeks of late. About 5.6 on the calls and about 2 million on the puts. Turning away from broad market volatility, it still is indeed earnings season. And there has been some interesting earnings premium developments out there. Last week, we were kind of talking about how it seemed, I think, Mark, you referred to it as the great earnings volatility sandbag. Last week, everyone was kind of sandbagging their numbers and then blowing through their straddles as a result. Saw a little bit of a flipping of that script this week, at least with a lot of the big names out there. Some of the big ones reporting this week were, of course, Tesla and indeed Alibaba. We actually had one of our regular questions of the week. We had another straddle battle because you guys like those. We asked you which one was going to be more accurate. We were asking you about Tesla, which was pricing in about a $20 straddle, about 8% at the beginning of the week when we asked the question, versus Alibaba, which is a little bit south of $5 or about a 6% straddle. We were asking which one was going to be the more accurate of the two. We asked you if it was Tesla, Alibaba, or to be fun, we added sell both or buy both. And Alibaba winning with about a third of the votes, which turned out to actually be the right answer, unless, of course, you say sell both, which that was overall the better answer. 17% going for that. 26% saying buying both. I guess they're trying to repeat the lessons of last week. And then about a quarter also picking Tesla as well. Tesla was one of the few underwhelming times in their recent reporting history. They were pricing, like I said, about $20, which was about a little over 8%. They actually delivered about a $6 move. There was more range in the after hours, obviously. We're just talking close to open here. And so they ended up being off by about 70% in that, at least in that near term. We saw some other retracements in that stock since then. So the overall move has been a little bit more aggressive. It sold off about 4% in the subsequent day. And even today, as we're recording, it's getting a little bit of that back today, up about 2% as the rest of the market is kind of unched. Today, we also saw Bob, I said, around about $5 is what they were pricing in and close to it, and actually delivering about $3.70. So they're off about $1. So they missed by only 21%. So they missed by the least, a.k.a. they are the more accurate of the two. So Bob, Tesla, a few other names coming off this week. Maybe Mark, we'll start with you. What was catching your eye this week from an earnings volatility perspective? What was lighting it up over there in the pit chat this week?
Yeah, I mean, Tesla was one that they got nailed. Straddle sellers nailed it, and then it kind of backed off. Earnings as a whole continue to be exactly what we've kind of discussed. So nothing overly exciting. Alibaba was a nice little surprise. I think the fallout from Apple has been kind of continues to be the big shocker for everybody, that the once great fruit company is now just a it's just a rotten apple, if you will. It's not the exciting, fun stock that it used to be. The dream is gone. It doesn't give people the tingle in their leg anymore.
No tingling, no syphilis for the Apple buyers anymore out there. None of those tingles. You're right. Apple's still in the low 90s as we're recording this, off almost another $1 today, 92.40 or so, off about another 1%. Yeah, the sell-off in Apple hasn't really abated too much. Not a lot of love coming out of their earnings, setting records, a lot of them in the wrong direction. The first time in a long time, first time ever. Sometimes for some downside numbers. A lot of their major product categories not delivering in China as well. A lot of negative stories. A lot of the media, I'm sure you guys have seen, have glommed onto over the course of the past week. Not surprisingly, of course, the big PR dump of Carl Icahn dumping their stock as well didn't help them either. He was one of their biggest cheerleaders in the marketplace. So when he gives up the ghost, even if it's materially not that significant from a PR perspective, it certainly doesn't help the cause. So yeah, two of the normal PR darlings of the marketplace, Tesla and Apple, taking it on the chin in recent weeks. Mr. Corner Office, what's been catching your eye out there from an overall earnings volatility over the past week?
Well, what's interesting, I'm going to stick with everybody's favorite fruit, and Apple. What's interesting about Apple at current levels, the last time I got a call about Apple and the stock repair trade, which was back in about 2 years ago, or about 3 years ago, in April of 2013, just about when the stock made a bottom. And somebody called late last week and said, "Now, what's that trade where you buy one call and sell two calls to improve your break even and just take your money and move on to the next trade?" And I've gotten a call on Apple twice. The first time it called the bottom, I know that is no, there's no legitimacy to the statistics there, but I got that call again last week when the stock was around 94. So we'll see. And it was, I not to out them, but it was the same person. So I just, sometimes there's the anecdotal stuff, and that's the one that wouldn't surprise me. The stock that we kind of watched around here that a lot of people have forgotten about, another, loved by the millennials, and everybody has to have one, and now nobody cares. GoPro, they reported last night. The stock's, last I checked, it's been mixing around, but last I checked, it was down a little bit. We had somebody that came in and sold a couple thousand of the 9-strike calls, which is a penny below the all-time low for that stock that expired on May 20th yesterday. And the stock's down 52 cents right now. They're not in any danger of having the shares put to them yet. And then we also had a guy that came in this morning right as the stock opened, and they sold the 1050 puts, willing to get into the stock there. They sold a couple thousand of the 1050 puts that expire this afternoon, and I think they took in over 50 cents on those. I think they took in 60-plus cents on those. So they may end up owning the shares at a net effective price of around $9.90. The stock's at $10.18 right now, so it looks like they may actually get assigned on those short puts.
Yeah, I'm looking at this one right now. And go figure that a maker of very expensive action cams, which you'd think would be a very niche market, would fall on hard times when they actually saturated that market, and a bunch of other competitors come in and start undercutting them on a price perspective. It always seemed like an interesting play for me that was getting so much mainstream love and was such a niche product. But you're right, lighting it up on the 10.5 puts today, and a bunch of other stuff. Lighting it up today overall in GoPro, about nearly 50,000 contracts having gone up today. That's about 2x ATVI, of course, is coming on the heels of their number, which earlier this week, which clearly the market not loving, hovering, like I said, around $10.18 right now. So yeah, perhaps some people out there showing a little bit of interest here, perhaps drawing a little bit of a line in the sand, saying this level, or in that case around the $10.5/$10 level, being where they don't mind picking themselves up some good old GPRO. Yeah, that one wasn't on our radar for whatever reason. It seems like it's very much a fad company, it seems like, and it kind of came really hard and then it kind of went away really fast as well. Kind of like BABA to a degree. Everyone was really, we were talking about this in one of our earlier shows this week, or maybe right before we started recording, how everyone was so obsessed with Alibaba was going to be the next big thing, and it hasn't really materialized, at least from a market fascination and interest perspective. Certainly not for our audience, the way a lot of people really thought it was, or thought that it would. Moving on quickly here from the earnings vol into the realm of commodity. Again, if you want to deep dive into commodity options and volume, come back at 3 o'clock for our This Week in Futures Options program, where we'll get into all things crude and gold and maybe some soybeans and 10 years and whatever else is lighting it up this week. Looking here at WTI options and what's been lighting it up out there. No surprise, this week we saw a bit of a rally out there in WTI. I think a bit of a rally is putting it mildly, on the heels of actually a pretty broad-ranging wildfire out there in the oil sands territory in Alberta and in Canada. So interesting things that have been driving crude of late. Not surprisingly, we're seeing some love for the calls out there, at least in the near term out there, looking at the WTI skew. Of course, front month calls being where the action is. Again, not surprising given the fact of just very, very recent near-term upside surge. Longer term, it's still the puts leading the charge, but the longer-term calls are getting a little bit more love as well, as we are inching up here into the 40s handles now, well north of the 20 handles where we were not that long ago, just a few months back. It seems like it was ages ago now, but just not about mid-February or so where we were flirting with those lows out there. So crude has rebounded nicely, seeing that reflected out there in the volatility skew. I don't know, Russell, you said people call up for crude for Apple every now and then. Or anyone ever call up to ask or talk about crude? Do you guys offer any sort of crude classes and the options over there, or anything on the commodity, maybe USO over there at the Options Institute?
No, but we're going to do a ETF option class in the fall that's going to, and a big portion of it's actually going to focus in on gold and oil and some of the other commodity-oriented ones, along with the currency. The ones that represent non-equity markets is something that we're starting to do some more work on. And then, of course, we're always looking at oil vol, because we've got the CBOE oil ETF volatility index, which makes us keep up with that market. It looked to me like we were starting to see just a little bit more love for the puts relative to the calls than we've seen in several weeks. When I checked in on it a couple of times earlier this week. So I don't know, and you can always take that two different ways, but I don't know if increased nervousness relative to a little bit of calm is a precursor to anything or not. I do know that seasonally oil is supposed to be holding up here, and it seems like nothing that's supposed to push oil down pushes oil down. So I wonder how much money is going to be. I don't want to say. A word is in my mind that I'm not supposed to say publicly. So something away on out of the money puts on oil for the near term.
I guess that bell means Russell is done with his thought for the moment. But you're right. Longer term of the puts, like I said, are leading the charge. I usually tend to discount the nearer portion of the curve because that's where so much madness lies. But it is worthy of note right now because so much of the move has been very near term pop up to see what's been lighting it up. And like I said, in the nearer, more frenetic portion of the WTI curve there. It is calls apparently leading the charge. But you're right. Longer term, the puts are still where the bids are. Bids all the way out to 35 strike and below, 35, 33 half here as well. So, interesting to watch. Again, if you want to learn more about what's been cooking out there in the skew, we actually do a pretty cool thing on that TWIFO show. We break down the developments, not just overall in the skew, because skew is often quoted as one number, and it's really two separate moving halves that create the skew. So we talk about what's happened in the call wing and the put wing over the course of the past week. So interesting stuff. Again, shameless plug, tune in to TWIFO this week, 3 p.m. Central, or wherever you find your favorite Options Insider programs to listen and learn more. Meanwhile, we're going to keep on rolling. Right now, it's time for our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, welcome to the volatility voicemail. Someone pointed out to me recently, it's volatility voicemail. You should get more. You should go out, reach out for more voice questions. I realized a long time ago, people for whatever reason are terrified to have their actual voices played on the air. They'll tweet in, they'll email in, they'll send their comments and questions via any other way. But for whatever reason, they're a little bit leery about hearing themselves on the old radio. So we call it volatility voicemail, but of course you guys are welcome to send in your questions, your comments, your thoughts, pretty much any way you like. Carrier pigeon, if it'll reach us here in the studios in Chicago, whichever way you guys prefer. Our man at the top there listed off most of the ways you can do it. Of course, you can also hit us up via the live chat as well if you are so inclined. All right, and let's see. We got a broad array of topics for our listeners have sent in for us this week. Let's just carve out a few. We're going to be all over the place today. It's kind of fun. I like that. Let's start off with a bit of an esoteric one from Topcat. He writes, "Are options less risky and volatile than contracts for difference?" Contracts for difference, CFDs. We don't talk about those a heck of a lot here on this network or indeed on our site, and I think you can probably intuit why. Not really a heck of a lot that for us of interest to parse there from a volume or execution perspective. What does go up on a lot of those is typically OTC, so a lot of it isn't really that transparent. As you might imagine with a lot of those marketplaces, a lot of it, the spreads are going to be wide, not exactly the most liquid markets. You have a lot of counterparty risk, et cetera. So in the general nature, you just say options, that's kind of a pretty broad umbrella, but for what we typically talk about on this show, which are standard listed equity and index options and things like volatility products that are listed on an exchange like the CBOE, all of these are listed lit products. So in standard, in general, all these products are going to probably, unless you get into some of the more esoteric ones, are probably going to have more displayed liquidity, going to be more readily accessible, going to have easier price discovery. All of the things that I think would translate into what you term as being less risky. Less volatile, probably as well, because again, they're not printing once every couple of hours or every couple of days, depending on how liquid these contracts for difference are you're talking about. Again, interesting question. We don't really get a lot of CFD questions here on the network, but an interesting one worthy of perhaps some note. That's a pretty broad category as well. That whole contracts are different, so you can cover kind of a wide variety of things there. But that said, 10,000 foot level. I don't know anything you guys want to add, Mark or Russell, on standard listed equity and index options versus something like let's say a typical OTC contract for difference.
Well, the CFDs don't necessarily have the kind of counterparty risk that you see in some of the more esoteric derivatives. So I don't know if you can cite the over-the-counter versus listed argument as far as risk goes, because you do know what the underlying market is, and you can get a price on that on a pretty regular basis. But my predecessor, Jim Bittman, one of his favorite answers to questions was, it depends. And it kind of does depend on, the specific trade. I mean, you could come up with structural reasons that each of them might be a little bit more risky than the other one, depending on how much leverage you're taking on, and what the option is on versus what the CFD is on. So I feel like this is a question that, like, a couple of people in an office where they trade CFDs want us to resolve their argument, and I'm not going to be able to do it for them.
That is a function we serve quite frequently here on the network, arbiter of all things trading-related arguments. And you're right, good point about the underlying there. So I guess we can give one check mark back to the column of CFDs that not always do they have the typical counterparty risks that are inherent with most of the OTC products we see going up there these days. And you're right, you probably could, like I said, find some random illiquid listed equity option or index option as well that would be very broad, and the markets would be very wide, and that would probably be a risky product to trade as well, because you're going to be pretty much trading with yourself to get in and get out of that. So there are use cases and examples for each, but I think in general, I think we can come down on one way or the other. And I think we'll probably come down on the side of the listed products for the most part. Mark, I'm guessing you guys don't deal with a lot of CFDs over there in the pit chat on a daily basis.
We don't deal with CFDs. Yeah, I mean, these kind of are interesting products, but unless you have some complex risk that you're managing, I think that they're generally inappropriate. So if you look at the people trading these things, they generally have a much more complex book of risk than people using listed options. So that would be my thought on CFDs.
Yeah, got to have a very specific use case to want to go out there. Aunt Agnes from Iowa is not picking up the phone to TD for her 10 lot of some CFDs out there. That'd be funny if that happened, though. All right, let us know if your aunt is trading these. We'd be curious to talk to her. Meanwhile, we're going to keep on rolling. Let's see, what do we got here? We've got one of our frequent writers / offenders here / questioners. Mark Brant, he writes in, since VIX inception, VIX trends up from July to October every year, just like seasonality in the grains. Sweet. He's also into selling the July 18 puts to buy the July 29 calls. He likes that risk reversal for even money. I don't know, Russell, you're big on your seasonality research and charts. What do you think of that? Do you agree with that general conception? VIX trends up from July to Oc every year, just like the grains? Or are you gonna take a counterpoint position to that? A little point counterpoint.
He's right.
That's it, huh? That's all you got from me?
Do you like how I left you hanging there for a second? No, he for my VIX book that's coming out in a few weeks. I did a lot of seasonal analysis. We actually just get, and one of the brokerage firms had a blog that reminded me of this today. April in general is our lowest volatility month on average, and we do if you took every year going back to the 90s and you created like one consistent average VIX chart, it does trend higher into the fall, and then you get pushback, and the pushback is, well, yeah, 2008. You take 2008 and it's still out, and it's still true. So it's just more accentuated when you throw the numbers from 2008 in there. And I guess 2011 a little bit with late August as well. So, yeah, I'm not, when I say he's right, just to clarify, because I like my job, I'm not talking about his trade. I'm talking about the trend that he has noticed. But we generally have, on average, seen, much like the commodity seasonality, you've got, beans tend to do something, or like I mentioned, oil is generally stronger going into the summer driving season. VIX does have that trend, typically going into the fall, which everybody still has in the back of their minds as being the riskier part of the year in the markets.
So just to put words in his mouth, then Russell says buy VMAX at the start of May and then go away and come back in October and just hold it in your IRA.
Can't lose.
Yeah. That's exactly what you said, right?
Yeah. No.
Any notes on VIX seasonality before we keep on rolling, Mark?
Yeah, it is interesting that a lot of people think that, October is the crazy month. If you look at all the big VIX blow-ups, they're all August. They're all August. 08, 11, 15. So maybe that whole everything in the summer is relaxing and easy is wrong, and we get our panics out earlier than people realize. So it's an interesting piece. The other thing to think about though is that there is some, it's a short amount of a data set to look at with a couple of really, really, really big outliers. So, that can throw off some of the seasonality. Let's call it seasonality calculations that maybe he's seeing.
Of course, it doesn't also help in August that the entirety of the French institutional crowd, which seems to dominate a lot of the paper in SPX and VIX, is off there on the Riviera just sunning themselves. So there's no one around to backstop the market in those crazy times. That probably has something to do with exacerbating the August effect, as we will term it now on the show going forward. But the French vacation fact, as well as the rest of the market, everyone typically takes August off for the most part. All right, we don't take it off yet. We still got a little bit of time left on the show, so it's time for us to keep on going into the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody. Welcome to the Crystal Ball. Like the name implies, this is indeed the portion of the program where we attempt to divine what those ever fickle, ever silly, ever capricious volatility gods hold in store for us for the week to come. This week was a bit of a challenging one because, like I mentioned at the top of the show, we had that non-farms wrinkle, so your prediction could be right going into the morning on Friday, and by the afternoon, you could be somewhere else completely from an implied volatility perspective, aka the VIX cash, which is, again, what we're prognosticating here. Last week, of course, we had the Rock Lobster sitting in for the Greasy Meatball. He was hovering around the 15 level. Mr. Corner Office, ever the buyer of all things volatility, went for a very aggressive 18 last week, and I liked myself right around a 15.5. That appears to be the Goldilocks as we are recording this here, right about a 15.40 out there in the VIX cash land right now. So I guess that gets me the winner chicken dinner, which I guess that means also I get the dubious honor / victory prize of going first for next week. So I'm going to pull it up here right now so we can get it nice and official so we can record all of our votes. And I'm going to start off thinking, we had non-farms this week. It didn't really juice vol the way a lot of people thought. It didn't. Also, earnings, for whatever reason, haven't really conspired to inject a lot of structural volatility into the marketplace. Most of the major names are behind us. And, of course, non-farms are in the rearview mirror. So barring some aberrant event, I think we'll be on the downside this time next week. So I'm going to say a nice, I'm going to say a robust sell-off of about, let's be fun. Let's go 14. Go big or go home. Let's turn around. I'm going to go to Russell now because I know he's going to say something crazy like 20 because he's buying all things volatility. So, Russell, should I put you down for about a 25?
I'm guessing 1401.
You're being too much prices right over there in the corner office.
I'm going to take 15.5, actually.
All right,
kind of flattish.
You're coming off a little bit from last week's extreme. We should actually keep track of these over the course of time, and maybe whoever wins the dubious title of winning gets something at the end of the year or has to buy something. I don't know. Maybe has to buy a steak dinner for everyone else or vice versa. So it gives us all sorts of incentive to guess wildly. All right, Mr. Greasiest of greasy meatballs, he who wants his own theme music. This will be, if you win this, you'll get your own theme music. How about that? That'll be an incentive for you. Where are you coming in next week?
14.
I just said 14. So you got to be, you got way to pay attention.
I take 1401. I take 1401.
All right, 1401.
Oh God.
I will take. Let's see. I'll take the under then. So Russ, I'll take.
Russell said 15 half. I said 14. So you at 13 half? Is that what you want?
I'll take 13.
13. Oh, okay. Substantially less. All right. Interesting stuff. Always nice to tell the Greasy Meatballs paying attention listeners. We can catch them, which is always fun. All right. With our prognostications aside, that means it's time for that music, listeners, which means it's time to bring to a close this episode of Volatility Views. But before we go, as always, let me check back in one last time with my cohorts and my partners. Reminder, too, this show brought to you by our friends over there at CBOE Live Vol. So you can always, of course, surf on over to livevol.com. Check out, it's a free trial. Check it out. It doesn't hurt you. It doesn't cost you anything. And we do pull a lot of the stats we talk about here on the show directly from Live Vol. Like I'm looking at it right now. So we wouldn't let them sponsor the show if we didn't use it and use it quite a bit. So check it out. And of course, like I mentioned last time, they also have that new addition they just added to the Live Vol family. It's datashop.cboe.com. So if you're interested in, let's say, a particular data set, you want the grains from 2009 to 2012, you can get that there. You can kind of make custom data sets, which is pretty cool. It's been kind of a hard thing to come by in the past. You kind of had to buy large blocks of data, probably things you didn't want, probably more expensive than you wanted it to be. But if you can kind of get it a la carte, just the range you want, makes it a little easier and also fits whatever use case you're looking for. So datashop.cboe.com. Check it out. And that said, since we're talking all things SIBO, Russell, you mentioned you have a book coming out. Tell us a little bit about that.
Well, I've got two books coming out this summer. The first one is not VIX related. It's actually an institutional, how-to strategies book. And then later this summer, I've got a VIX book coming out. Before that, and really the everybody around here is actually reading the institutional book right now. So, and coming back to me with all kinds of fun grammar errors. In fact, Peter Luss just walked in here, and I said, "Get out, get out." One other thing I wanted to add to the forecast thing, where we're guessing VIX, I think we need a random number generator to be in the mix, and see if we can beat the dartboard or something.
I like that idea.
Well, we'll have to set the bounds. What should be the bounds for the random number generator, though? Should it be 1 through 25, 1 through 40? I mean, because it can start
1 to 80. 1 to 80.
Yeah.
I think it should be the last month's high-low range.
Oh, so like a rolling range.
Yeah, I've thought about this too much.
I was going to say, you're putting a lot of work now into the crystal ball segments. Okay, you're responsible for programming the random number on every show.
I am going to. We are going to start adding a random guess to the mix next week.
All right, we'll start keeping more track. People have written in before asking who's winning and stuff, so we'll keep more track going forward, and we'll have some sort of prize at the end of the year. Maybe it'll be a prize the winner has to lose, or vice versa. Something fun and or shameful will be a good thing to do. And so, Russell, you've given yourself more work. Congratulations, sir.
Yay!
All right. Anything else cooking in the land of the Institute?
No, next week's a big week. I'll see you out in California at OIC, and I'm going to the Money Show before that. So that's the two big things going on. I guess what's going on around here is I won't be here next week.
Yeah, no one will be here next week. It is, of course, the big options industry conference. I think the Greasy Meatball will be the only one holding down the fort here next week. Maybe you'll do Vol Views by yourself, Mark. That'll be fun.
Maybe I'll do it from your office. That won't be a problem.
Oh, there we go. I think the whole team is going to be out in L.A., at least a good chunk of it, the Chicago branch. So it may be hard. But that said, speaking of Chicago branches, what's cooking in the Chicago branches of Option Pit and Carmen Line?
Things are great. we're trading them up. We're enjoying our time, and go to optionpit.com and read our blog. You write a good blog every day.
There you go. Always nice to be enjoying your time. Surf on over to optionpit.com to learn more. Maybe you too can perhaps enjoy your time over there. And on behalf, we enjoyed our time on the program today. I hope you did as well. And on behalf of Russell and Mark, and indeed myself, I thank all of you for tuning in. And we'll see you next time right here on Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.